Investors have been spooked by the return of the US-China trade war. Wall Street sank on Friday after President Trump threatened 100% tariffs on Chinese exports in retaliation after Beijing announced new restrictions on rare earths. China controls as much as 99% of the supply chain of some rare earth metals that are crucial for batteries, electric cars and the semiconductors that power AI. Kathleen Brooks is Research Director at XTB. Kathleen, before Friday, markets had largely moved on from the trade war, but did they move on too soon?
I think they did. I think it certainly felt like the AI trade was just taking over everything and that would be very resilient to politics. And I think the fact that tech stocks and AI stocks in particular, particularly those chip stocks, that they sold off the heaviest on Friday really tells us that, politics and tariff risks, they haven't gone away.
Well, markets, as you say, have become hugely dependent on AI companies. They need rare earths that come from China. So is China showing it could slow down the AI boom if it wanted to?
Well, I think it's certainly what we've seen over the weekend and into the start of this week is that Donald Trump's position is weakening. He was the one that backtracked from this, said that things were getting out of hand, that the markets overreacted and that they'll work something out with China. We haven't really heard anything from China. Now, they very unexpectedly put some export restrictions on their rare earths. They know that they hold a stronger hand in this. And that's going to be a problem for Donald Trump and the White House, particularly as they, try to get their reciprocal tariffs right with China.
More broadly, Kathleen, we start an earnings season in the US this week with valuations very high. How nervous should investors be about the concentration of gains in a handful of AI companies?
Yeah, I think that is one concern. But this week, we certainly are expected to start with a positive outcome. We had good news from Delta and Pepsi last week. We've got US banks this week. And actually, this is going to be expected to be the first time that US banks will report $9 billion in revenue, largely due to a big increase in that deal-making and investment banking activity. So if they can get that back to the levels it was in the last kind of few years, then that's going to be really, really positive for sectors other than tech. But I think you're right. We've been overly reliant on tech earnings. And because valuations in tech have been so stretched to the upside, if there's even a hint of disappointment in those tech earnings, particularly for big tech, but particularly for the semiconductor chip makers as well, then that could lead to big downsides in their share price. But I don't think everything's going to move in one as one. I think we're going to get very idiosyncratic moves where those that outperform expectations, they will do well and be rewarded by shareholders. Those that underperform, they will be punished.
The pressure's on then? Do you think even a small disappointment could have big consequences?
I think they will, particularly for companies that have seen a huge run up in their share price. I'm talking about the likes of AMD, the chip maker that signed a deal with OpenAI. If there's any weakness there, then we could really see shares fall very precipitously, a bit like what we saw with Oracle not that long ago when they came and reported disappointing profit margins from their cloud business. There's a lot of expectation on AI. We're calling it the third industrial revolution. If this doesn't actually start showing up in the bottom line and boosting these companies' profits, then I think that a lot of froth could come off the market.
What did you make of some of the warnings we heard last week? The Bank of England, the IMF and Jamie Dimon were all among voices warning that this could turn out like the dot-com bubble of 25 years ago.
I think that there's some validity in what they're saying. Yes, stock markets are at record highs, and whenever things get to record highs, people start getting nervous. But I don't think it's the same as the dot-com bubble. And the reason why is because we are expecting huge revenues, big profits from the tech companies. Nvidia is expected to report over $50 billion in revenue. Microsoft, who is a hyperscaler spending a huge amount of AI, is expected to report over $70 of revenue for last quarter. So the numbers are justifying the valuations. From a price to earnings ratio, they don't look too stretched. That's for the bigger companies. Some of the smaller ones, well, yes, there's a lot of expectation in those, and they'll be the first domino to fall, I think. Whereas I think some of these massive tech stocks that are valued at trillions of dollars, I actually think that they are much more resilient to those economic shocks.
That was Kathleen Brooks of XTB. Don't forget, you can watch more videos on Reuters.com.